You're about to witness a conversation between myself and James from Bloomberg Intelligence about this Bitcoin ETF. Remember, this ETF is coming. We're lining this up. The institutions are lining this up for this to come. You need to understand what this ETF is, what sort of market effect it's going to have. And in this conversation, I'm going to ask James some of the questions that other people have not asked him about how the ETF will impact retail investors like you and I watching this, and how the institutions will use those ETFs to gain control of more and more Bitcoin. So please subscribe to this channel. If you haven't already, help me spank the YouTube algorithm when it comes to Bitcoin content to get it out there in front of more people. And enjoy this conversation. If you have any questions, put them in the comments. But yeah, let's go over to the conversation with myself and James. So should we just jump into it? I'm not
Yeah, whatever.
so I apologize in advance if we're a little bit all over the place or anything like that.
Feel free. I'm ready to go wherever you want to go.
Excellent, perfect. So James from Bloomberg Intelligence, the part of the duo, the Batman and is it Batman and Robin? I guess then we open up the debate of who's Batman and who's Robin. So let's stay away from
Well,
that.
technically, Eric is my boss, so I guess I would have to take that out. But I am more leading the charge on the actual crypto knowledge side of things.
Okay,
He is, yeah.
cool. So tell us a couple sentences on how your journey got to Bloomberg and focusing on the Bitcoin and the Bitcoin ETF part.
So it's in a couple sentences, it's kind of hard because it's kind of a long journey. I mean, as far as the Bitcoin side of things goes, right? Like I'm like pretty much anyone else you'll speak to. Like you hear about it at first, and you're like, that's stupid, and then at some point you go back in and you take a second look, and you're like, okay, that's actually pretty interesting. So for me, that happened when I was in 2011, when I was in college. My suite mate was mining Bitcoin for Silk Road purposes, and he used my computer to mine Bitcoin. And my computer blew up, and I'm convinced to this day that it was because he put the mining software on my computer. So that was my first experience, and I didn't have any experience with it again until I joined Bloomberg right out of college, and I covered ETFs and hedge funds and mutual funds. And I was at a conference where Cathie Wood was actually talking about this, and they wrote a white paper, and that's when I got reintroduced to it. So I had been covering ETFs for a long time at that point, and I just recently after that I had moved to doing research on the space. And I reported to Eric Balchunas, who's our ETF analyst or senior ETF analyst, and I reported to Mike McGlone, who was our commodity strategist. And at the time, he was like, I think we should start covering cryptos. What do you know about them? And I was like, actually, I know a decent amount because I started getting interested just over a year ago. And so basically that overlap has served me very well in this space. Particularly, I did a lot of covering what was going on with the Grayscale trusts and unlocking of shares and the complexity around that. And now I'm most well known for covering this race and all the all the goodies that are coming along with it. So yeah, I guess that's the background. It's a little more than a few sentences, so I
No,
apologize.
you're no, don't apologize. So you're definitely the one person that it's number one on my list on Twitter to watch. So saying that, what is your Twitter? Let's just get that out of the way so people can follow you as they get to learn about you. If they don't, for the five people that don't already know who you are.
Yeah, it's J Safe, so JSEYFF. It's just my first initial and the first few letters of my last name.
Perfect. So everyone should go follow James and follow everything he says because about it hits the Bloomberg desk and I think about 30 seconds later it's tweeted out. So it's the best source of information that I've personally found. So I appreciate that. Um, so the first question I have for you, I know you guys are talking about your 90% certainty around this ETF being approved by January 10th. What happens if the 10% is right? What
Yeah,
happens if they're wrong? What happens
yeah.
next?
So there's a few ways that we could be wrong. Initially, we left at 10% just because we weren't certain, like absolutely certain that Gary Gensler was on board with this. Like, he runs the SEC, right? And at the end of the day, if he really doesn't want to allow this, he can probably find a way to not allow it. That would honestly likely end up losing in court, in my view. So that was the risk initially, right? That he would find a way because him and Elizabeth Warren are very anti-crypto, and they would find a way to deny these things, or even if they don't find a way, just do it anyway, against all legal precedents. So that was the original, but now the 10% is more so a little bit of that they'll like at the last minute back down, but it's more so that the SEC just isn't ready. And the only way that it wouldn't happen by January 10th, I don't see that. I really don't think they will deny ARC on their Jan 10 date. I still, like you said, we're still 90%. We think it's going to happen. But the one way it might not happen is if they basically convince ARK and 21 Shares to withdraw their application and give them assurances that you can refile and we will make sure you go out in the first wave sometime in March. So that would be the real conundrum for like the 10%. Again, I think that's pretty unlikely. We can get into like all the things that need to happen, but essentially there's two processes. There's this 19B4 process, which is like all these dates where you hear like, oh, it was delayed or denied. Haven't heard approved yet, but there's all these dates, and that's the 19B4 process. That's just basically the Division of Trading and Markets, which Gary Kessler just tweeted about today, talking about what that division does. And um, that's the main thing, right? That's what all these things have been denied under in the past. There's also this other process where the Division of Corporate Finance has to basically sign off on the offering documents or the prospectuses. Like you have all the proper risk disclosures, you're properly operating the fund, all your third party like administrators, custodians, things like that. All the third parties are properly disclosed. Like it's just fine tuning. It's these long, sometimes multi-100-page documents that just lay out everything of how it's going to work. And the SEC needs to sign off on that too. So the other way that I think is more likely if the SEC isn't ready by Jan 10th is they approve under that 19B4 process, which is the critical aspect. That's the thing we've been talking about for years. That's the thing that really matters. But basically don't sign off on those prospectuses or S1s as they're called, and basically uses and keeps working with the issuers and then eventually gets comfortable with it. So they can approve under 19B4, but nothing can launch until they also have approval for their offering documents, their prospectus, their S1, or in Grayscale's case, S3. But essentially, there's other ways that they can slow the roll here. But as far as we're concerned, it's happening.
And how long would it take if they approve the 19B4 process, but they don't approve the S1? Is there a time limit on that before it can start trading?
Yeah, so there is no set time limit, right? Like usually if you already have your S1 signed off by the SEC and then you get 19B4, you could typically have something list in a day or two, right? Grayscales, there's a lot of nuance in like what's going on with Grayscale because technically it's already operating as a trust, it's traded OTC. So Grayscale argues it could be an uplisting. I've heard other arguments from different people that it's more complicated than that. So there could be some nuances there. But again, we'll see that when we get closer. But the real thing is like the gap is unknown. It could literally be a day or two, or it could be weeks or months. So I wrote an article where I said basically there was a window in November where like if the SEC really wanted to approve all these 12 spot Bitcoin ETF applicants at once, there was a small window they could do it in November. And if they did it then, my view was that it would be months before they approved the S1s, right? They'll approve the 19B4s and then wait months before the S1s. The longer we get into this process, I think the shorter the time period between those approvals and the ultimate listing, because of the S1 approvals. But there's no way to know. There's no like set like, oh, here's the guidelines of how long it normally takes. This basically takes as long as it takes for these issuers to answer all the SEC questions and fill out and add all the information to those documents and do everything the SEC is requiring. It's in essence to list these things.
Right. Okay. And recently we had a little bit of confusion in the retail perspective between the in kind and the cash creates ETF. So
Yeah.
can you give us a little summary of what the difference is and why the SEC wants one and the issuers want the other?
Yeah. So it's not just the retail community. It's like a really complex topic. Like if you look at the maps, I saw a lot of people in the crypto community are like, this is ridiculous. Like what's going on? There's a lot of reasons why there are things set up like this. There's a lot of parties that are like siloed off from each other. So the risks are distributed, right? So there's a lot of reasons why things operate the way they do in the back end. And at the end of the day, if you're buying this thing, like it's not going to impact you that much no matter what the solution is from the SEC. There is some risk that potentially, well, I'll just get into the difference. Basically, the way an ETF typically works, right? The way they were invented was by a guy named Nate Most, and he had a lot of commodities background. So I'll just explain what an ETF is and how it works, and then we can talk a little bit about the nuances. But essentially, the idea came about from what's known as a commodities warehouse and the way in commodities warehouse receipts, right? So the way that worked was if you had some sort of commodity, say silver or gold, and you put it in a vault, or you had grain or whatever, and you put it in a warehouse of some sort, you would get a receipt that says you have X amount of gold, silver, some other commodity, and you don't have to actually move that commodity back and forth every time you want to trade it. So people would trade receipts, and that had been done for a very long time. Like that's just how it operates. And the idea was like, let's do that with equities and a basket of equities. So the first one, the S&P 500 ETF in the US. And basically it says like, you create all these shares, all these little pieces of paper, these receipts, which are ETF shares. And in order to create those shares, you need to deliver us the underlying stocks. So you give us the stocks, we give you a separate portion of those shares back. And instead of having to go out and buy every individual stock every time, you just trade these pieces of paper that say you own the rights to this. And there's some fee for holding them in that warehouse or whatever. That's essentially how an ETF works. And if you want to, you can always at some point go hand in those receipts and then get the underlying asset back. That's the way it was supposed to work. That's the way it does work with equities. That's the way it's going to work with Bitcoin at some day. So you can always, the reason that I'm sure some of your listeners are familiar with the Grayscale trust products, they don't have that mechanism where you can create and redeem, or you can hand in those shares and get back the underlying asset. So what that mechanism does is if the shares are trading way higher than the underlying assets are trading, all of a sudden you're like, okay, I'll hand in the underlying assets and take delivery of the shares and then sell those, and all of a sudden you have a risk-free arbitrage opportunity, right? You can make a profit. And vice versa, if it's trading lower, you can do the exact opposite and make an arbitrage profit. So what happens with an ETF is the price of the ETF is always going to be very close or tightly tracking the underlying value of the asset. Now there's some friction in doing that creation redemption process. My boss Eric refers to this as like the flux capacitor, if you know Back to the Future. Like, it's the thing that makes ETF work so special. And one of the benefits is when you do that process, there's no taxable situation, right? Like when you're trading cash for something, you're buying something or selling something, that's a taxable event. When you're trading two things, shares for shares, it's a non-taxable event, particularly because they have the same value, right? So that's one huge benefit. That's why ETFs are super tax efficient. And that goes us to this other situation. There are ETFs out there, particularly a lot of derivatives-based products, where rather than actually handing over the underlying asset to create shares, you can hand over cash, or you might hand over some portion of cash. So you might get a bunch of the underlying assets and also hand over cash, and in return get the shares. And theoretically, then there's all these other players, market makers, authorized participants. They kind of sit between the end buyer of the shares and the trust. And that's why things can get complicated, but it's a very efficient structure for the traditional financial markets. And essentially, when you do cash, theoretically, what the SEC seems to have been pushing is they want cash create. They don't want the underlying brokers touching the Bitcoin. They want the fund to actually go and buy it. The problem with that is that it could be a taxable event. So there's a lot of nuance here, because if you're getting cash and then buying it, or you're selling the underlying asset, in this case Bitcoin, and handing back cash, that's a taxable event. So one, for like Grayscale, this would be bad for them because they have a lot of Bitcoin that has a lot of built up value. They have a low cost basis, so they bought at X dollars and now it's worth 20x, and they'll have to pay capital gains in selling those. So that's a potential risk. There's other ways you could structure it where that necessarily wouldn't happen. You can kind of take advantage of it, and that seems to be a lot of what the SEC and the issuers are fighting about right now. Fighting's not the wrong word. They're kind of like trying to figure out the best way to do this, right? So there's a lot of nuance in it. The best end case scenario, like if you're an investor and you want to buy one of these things, it's not going to make a huge difference for you. You might have a little bit wider spreads. There might be some other issues. But for the most part, like, it's going to be vastly superior to anything available on in the current markets for getting this type of exposure on the traditional financial rails, right? So like if you're an investor, it doesn't matter. But if you're an issuer, you care about these things. And the ETF product and structure has been tried and true and tested in the markets for a few decades now, so people like them. But the that is like I'll answer any questions, but at the end of the day, like, you come back to the fact that this is what's being talked about, right? Like, you are so far deep down the rabbit hole, the nuances of how these things are going to operate. Like, the fact that they're doing this is just strong indication that they are going to they're heading towards approval. And our indication is that the SEC prefers the cash create model. A bunch of issuers prefer the in-kind model. And it sounds like they're trying to come up with some sort of hybrid version that will satisfy both. But we should see some movement on this literally this week, I'm thinking.
Yeah, I actually understand why the SEC prefers the cash creates, because you can then control where the Bitcoin is coming from and at least put that under the purview of U.S. institutions rather than having an OTC desk go and find Bitcoin from anywhere, right? You don't want that.
That's probably what part of the reasoning is, but at the end of the day, it's these authorized participants too. So like, it also adds a little bit of complexity because technically some of these brokers and a lot of these banks who are authorized participants are the people that you can't just go out and get Bitcoin and then hand it to BlackRock and be like, give me the ETF shares. You need to go through a market maker likely. So like you're going to put in an order and a market maker is making markets on those. And then some market makers are also authorized participants. But at the end of the day, what's going to happen is like, imagine it's like some trader, some trading firm is going out, buying the assets, and then dealing with the authorized participant, which typically tends to be a big bank or big names in the financial industry, and they're the ones that have the right to create and redeem those shares. So there's a lot of restrictions on like who can and can't touch Bitcoin. I mean, SAB 121, there's a lot of other issues. So this would be operating like through subsidiaries of subsidiaries potentially, because technically they'd be separate entities and all these things. So there's a lot of more complexity due to some of the rules basically that the SEC has set up that are causing some of these problems. But again, there's ways like, you got to realize these firms operating these things are some of the most efficient capital markets players in the world. The Citadels, the Virtus, the Jane Streets of the world, right? Like they're not going to be going to like some sketchy place where they could possibly get ripped off or get them in trouble. They're going to be going to where they can find the most efficient markets, and they're going to prefer regulated markets. Almost pretty much, I can virtually guarantee it. So there's arguments to be made on both sides. Again, I am with you. I know why the SEC wants it, but I personally don't think it's that critical. But at the end of the day, if that's what they're going to require for these things to launch, I think the issuers will likely play ball.
Yeah. Okay. Do you think that there's a favorite child in the market? Do you think that obviously a lot of Bitcoin Twitter thinks that BlackRock, Larry Fink calls Gary Gensler and organizes exactly what's going to happen? Do you think there's a favorite child in the market?
So let's be very clear. They do have like some power. They have a lot of power to lean on the SEC more so than anyone else in this race. That said, there is definitely no favorites. If there were favorites, look, we just saw this move where they delayed Franklin Templeton and Hashtex's applications, which were not due for a decision on January 1st, right? And the only reason to do that would be because you are not going to pick favorites, right? So there's 12 applicants. I could make the argument that Franklin Templeton was so late to the game. They didn't even start applying until September, late September at that for the 19B4. So like if you were just fine with picking a few favorites, like you would have done it, right? Because then they could have waited and approved anyone in December and then so on. But obviously they're trying. There's date. So basically, once you I talked about the 90 before process, so there was delays, denies, like you go delay, 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 and then you either deny or approve. So you get to a point where you can no longer delay. But after some of these delay periods, there's these comment periods where the SEC can't make a decision because they have to allow for public comment, which makes sense. A lot of things that the government agencies are doing, they have to allow for public to comment so that they can give their input. But the SEC won't make a decision there. So basically, by doing this and going super early for a decision that wasn't due to January 1st, they're getting that comment period over, in my view, before that January 10th deadline. So one, I don't think the SEC is definitely not going to pick favorites here, right? For sure. The only thing that you could argue potentially, and Eric's more in this camp than I am, is that the SEC might try to find a way to like allow the other guys to go and then hold back Grayscale's conversion somewhat. I don't know how they would do that. There's a possibility they could try to find a way to do it. I don't think that's likely. I think the SEC is just going to let them go all at once. But in all indications that the SEC is doing everything they can, because like I said, they could have literally just, there was a time period where they could have just left one or two of these guys in the dust and approved everyone else. And there's 12 applicants, so it's not like they'd be picking a winner. They could have let 9 go at any point from now until January 1st, essentially. And they didn't do it. They said they purposely went over a month early to line things up for an early Jan approval of basically every single application that's before the SEC.
Excellent. So there's a part of the retail audience that I like to call doom and gloom boomers, and a couple of questions that I think they have and a lot of FUD that's being spread is, do you think that the ETF could impact the depth of future bear markets because of potential manipulation that could come into it as a result of the ETF product and the derivatives that can be built on top of that?
Yeah, so I mean, it will definitely affect. Like right now, you can look at things. I mean, Alex Thorne constantly tweets about this, and Galaxy Digital Research does research on this. The options markets on Deribit, I think it's Deribit, and other places like it's actually moving the market, right? So I don't, from that perspective, that we already have derivatives that are moving it. That's the way the markets traditionally work. But at the end of the day, people are worried about like paper exposure, which I think is kind of what you're getting at. But at the end of the day, yes, theoretically you could have paper exposure using options that will ultimately be written on this specific ETF. But no matter what you do, if you want to create shares or redeem shares of this ETF, like it has to hold Bitcoin. That's what it's going to hold, right? So it is going to be spot exposure. That said, it's kind of like the way to think about it is it's almost like being locked up on an exchange. Like, yeah, we know that there's trading on exchange, and sometimes it's literally just an exchange moving one number from one account, and it's not actually impacting things necessarily on the on-chain evidence. It'll be the same thing with the Bitcoin ETF. Yeah, there'll be Bitcoin in the ETF, but those shares don't necessarily have to touch the underlying market. This happens. There's ETFs that get super liquid where there's enough market makers on either side where like you don't actually have to do a creation and redemption where like basically if you or I go to buy, I might just be buying from you rather than doing anything that affects the underlying Bitcoin market. But at the end of the day, if you want to create shares in this thing and money is going to be pouring in, I can guarantee you it's going to end up being buying of spot Bitcoin. That's the
Right.
way it's going to operate.
What would
Now, derivatives on that is a whole different situation, and you can talk about that. But the paper Bitcoin exposure in these trusts that's going to be that's overblown. We'll be able to see. You'll probably be able to see where these Bitcoins are.
Yeah, because you'll be able to audit it very easily, right? It's not like gold
Yeah,
where
I
you
mean,
can move it around.
yeah, Grayscale hasn't released their actual wallet or wallets, but Osprey, which operates the Osprey Bitcoin Trust (OBTC), which is a competitor GBTC, much smaller, but they have released their wallet. You can actually go and see it on chain how much Bitcoin they have. I suspect there will be some issuers that are going to do exactly that, or maybe say like, here's a handful of our wallets, we're going to keep some of them private because whatever reason, but like you should be able to see it, and I suspect that I mean, Coinbase has given asset. There was a whole thing about like, oh, Grayscale doesn't actually have the Bitcoin they're supposed to have in this trust, but Coinbase quickly came out and basically confirmed they have all the Bitcoin that they're supposed to have.
Yeah. Well, speaking of Coinbase, I wanted to ask you because again, doom and gloom boomers always talk about what if they don't understand the difference that Coinbase Exchange is very different to Coinbase Custody. And of course, what would happen if in this scenario for a retail investor that was invested in an ETF if Coinbase Custody was hacked? What would be the normal process of that?
That's a good question. So there's a few things that we can talk about on here. So like the first thing is like the main thing I hear on that front that you were hinting at is like the SEC is suing Coinbase. They're not going to allow them to be the market surveillance participant. They're not going to allow them to be custodying things. The first thing I would say to point that out is the SEC has no problem with anything Coinbase is doing related to Bitcoin. The SEC calls Bitcoin a commodity. It's the one thing they will call. I have written stuff where I say that the SEC implicitly has accepted Ethereum also as a commodity, but that's not as guaranteed. But they will say it on Bitcoin. So they don't have a problem with anything that Coinbase is doing with Bitcoin. You read through that document, they're not accusing them of fraud. They're not accusing them of manipulation. They're accusing them of being an unregulated securities broker and claiming tons of these tokens are securities. So that's how I would answer the first part of that question, right? Like it's not an issue. It's likely not an issue. If it were an issue, it would have come up. We would have seen some of these S1 amendments that we've seen as
Yeah.
these issuers are talking with the SEC. They would have been like, you can't use Coinbase, but they don't have a problem with that, particularly because of it being with Bitcoin. Sorry, I forget the rest of your question.
What would happen if Coinbase Custody
Uh,
was
so this is the other part. I think my personal view is that I think some of these ETFs will have multiple custodians. Right now, we only see one custodian on them. Some of them haven't even released. I don't know what Hashdex's custodian will be. Um, I think some will have multiple custodians. So like you'll have one that'll be like, oh, we have half of our assets in Coinbase, and then we have a quarter in Gemini and a quarter in BitGo, or what have you, right? I think that's how things are going to break out to like diversify like the risk of that. That
right?
said, these ETFs are likely to have insurance against those types of things. Like if you're a BlackRock and somehow like the Bitcoin gets hacked, like it's BlackRock is not going to let their reputation fall and like let that go. Obviously, there's depends how big things get, but there's going to be insurance policies. There are ETFs out there where they have like essentially they're called revolving credits. It's essentially like a credit card that they can draw down on if they really had to, if they couldn't get access to it for some period of time or what have you. I haven't seen that specifically in these documents, but I would assume that's what it'd be. But that's an eventuality that I haven't really given like a, well, obviously I've given some thought to it because I said that, but it's not something I've really truly deeply
Sure.
thought about. But again, like these guys, the last market, you kind of had these people that you thought were the adults in the room, and it's become very clear that they were not
They
adults in
weren't.
the room. But I can guarantee you that the likes of BlackRock and Fidelity and Invesco, they are definitely the adults in the room. They
Yeah.
have massive compliance teams and people like this. So they're doing their due diligence. They're going to do the best that they can, essentially. So obviously that's a fringe risk, but that's the game you play if you're going to
Yeah.
be investing in this space.
Yeah, the last market, surprise, surprise, the guys in the t-shirts and the sandals were not the adults in the room. What a shock! What a damn shock!
Yeah.
How do you think? Because there's obviously currently a premium on MSTR and the miners, et cetera, because people can't get access to them. What do you think? What do you think happens to them as soon as an ETF starts trading, in terms of the premium attached?
So Mm, So basically, the way to think about miners is I think about them a similar way to gold miners. They're basically like a levered play on Bitcoin, right? So when you think about like there's these ETFs. So I'm going to use the gold miners example to about the miners. We can talk about MSTR after in a second. But essentially, the way to think about gold miners is like the junior gold miners specifically are very volatile, and they're like smaller shops. And basically, they're so that means that their fixed costs for operating are higher as a percentage of their total costs, right? So if gold in that case, or in this case Bitcoin, if you're a smaller, relatively smaller miner, you have much higher fixed costs than you do variable costs, right? As a percentage of your overall costs. So what happens is you are like levered to the price of the underlying asset, whether it's gold or Bitcoin. So like if you're profitable at like, I don't know, 25,000 Bitcoin, you're going to continue to get more and more profitable as that money goes up, and there's going to be a lot of like convexity around that profitability number of pricing, right? So like if you're a gold miner and you have like my rent and my paying for taxes on this land and oil and gas or whatever, like you're going to be paying that, and then so like if the price of gold goes too low and you're only pulling out a certain number out of the ground, or you're only mining a certain number of Bitcoin, like all of a sudden you're going to go way down once it goes below that price where you're profitable or break even, and it's going to shoot way up because you're going to get more and more profitable as you go up because your variable costs are lower. So that's the way I tend to think about miners. They tend to be a little more leveraged to the price of Bitcoin. Obviously, there's other risks and idiosyncratic risks with all of them. So I don't know, that's the way I think about the mining sector. MSTR, I do think the premium, it's hard to say like, oh, what is the underlying MSTR business worth versus what is the Bitcoin worth on their balance sheet as compared to the debt.
Yeah.
But I do think if you calculate that premium of like, okay, here's the value of the business and the value of the Bitcoin on an enterprise basis, like, and it's trading X percent above that, I do think the ETF will theoretically take some of that away. I don't know how much of it away. Um, if I knew that, I'd probably be a trader or a portfolio manager, to be honest. But
Yeah.
like that's just the framework with how I think about it, because the spot ETF would be the most efficient manner with which to get access to
Absolutely.
this on the traditional financial rails, right? We can get into like the futures ETFs and where we see demand coming from, but the spot ETF is based. We've been calling it the holy grail for 3 years, 4 years now. Like people think I just started covering the space. Like I can go back to 2018 when I was tweeting about these grayscale trusts
No,
and
I've
ETF
been saying,
possibilities and stuff.
I've been saying, I think the ETF is the single most important event for Bitcoin since Bitcoin was incepted itself in terms of ownership. So I completely agree with your thinking. What sort of net capital long influx do you think is gonna, based on your research, is gonna come into Bitcoin through the ETFs or even through other channels over the next 1 year, 3 years, and 5 years? Because it's gonna be a compounded effect, right? Once the returns start getting published, et cetera, et cetera.
Yeah, so I think there is a lot of like overhyping and hopium that's going to come from this. I mean, um, so I'll get real quick. So Galaxy Digital has written their paper. That's the best research paper and the best breakdown. They try to guess from a bottom-up perspective on how much money will come into the space based on like trying to figure out like who will get access to it, what percentage of those people will get access to it, what percentage of of those people will they put their clients' money in, and what percentage of the portfolio will go to this thing. And I agree with the whole entire framework. Their number is they have 14 billion in year one. I think it'll be lower than that personally.
Okay.
We estimate around 10 specifically. Um, but here, wait, I'm sorry, I'm going to pull something up. We estimate around 10. So one of the ways that I'd like to do it is like try to figure out like let's look at examples, right? So we have these ETFs available in Canada. Canada is the most similar market to the US, but it's still not the US. The US is a much bigger market. People come from all over the world to use our ETFs. We like to say we export ETF liquidity around the world to institutions.
When you
Retail
say
investors can't do it.
when you say much bigger, what you mean is you're 40 times bigger than Canada and the United Kingdom, where I'm from. So just to
Uh, yeah. So basically, so US ETFs have 7.6 trillion. Canadian ETFs have 290 billion.
okay.
So correct. So one of the ways I like to look at it is like kind of estimate based on where things are. You also use Europe. I use European crypto market. And basically the estimated using Europe as a percentage of assets and applying that to the US total assets. So basically seeing like, okay, the percentage of ETF assets that are in these products in these regions dictate that we should have this much money in crypto assets, right? In crypto ETFs. So currently, we already have. If you include GBTC and these futures products and these other grayscale trusts, we already have over 30 billion in assets, right? So if we look at the European model, which I think is not analogous to the U.S., right? I want to be clear. Like I do not think what's happening in Europe is analogous. They have a much different and stricter regulatory regime on who can buy these things, how they can be bought. But that says we should have about at least 32 billion in these products, right? So we're at 31. So that's a low end. If you look at Canada, it tells us we should have 74 at some point, like some steady state, if we're getting to in line with Canada. Now, I think some of the Canada assets are from U.S. investors and investors that will ultimately leave Canada and come to the U.S. So I think we'll end up like part of this is really hard to figure out like the asset levels because like if this thing goes on a massive run or collapses, which we've seen this thing go up of multiples of multiple
Times.
times or it's gone down 80% many times, but I think we'll be in like the 40 range over the first year, which would be around 10 potentially, but that's also assuming there's as much interest as like the surveys have showed there to be. The other thing is I would say is like this is more, as you hinted, like a longer term game, right? I think there will be hundreds of millions that flow in the near term, few days or weeks, but the billions will take a long time, right? Like because you're going to have advisors that they're going to put like 3%, maybe 5%, possibly as low as 1% of a client's portfolio into this stuff, and they're not going to just, oh, this is launched, I'm investing immediately. Now, one of the things we've seen in surveys is these advisors, one of the things they care that the SEC hasn't approved these things. They want more regulatory clarity on this, and they want a spot ETF. That's their vehicle of choice. So those things will definitely see some early adapters, these smaller RAAs, um, uh, independent advisors. Think smaller shops, people running their own shops, maybe a couple people that manage a few families' money, right? They can move quickly. But these bigger shops, wirehouses at banks, these wealth management platforms, it can take years before they sign off on an ETF being able to be sold, right? But at the end of the day, what it will really signal is basically the SEC's acceptance and regulatory oversight of this market that will get a lot of people more comfortable with the asset class. So that's really the benefits here to really think about. It's more of a long-term benefit in my opinion than like, oh, it's approved to the moon immediately. It's more like, all right, these people are actually going to start doing more and more research because now all of a sudden these things are approved or they're
Yeah, I mean,
getting approved. So
gold had a consecutive 8 up years after the ETF. So, tell me one other thing. Like, obviously, iShares doesn't want to be beaten up by ARK Invest, right? So the game theory part of it is also gonna start taking place. Like, if ARK is gonna go 0.8% on a fee, BlackRock is now incentivized to come in and say, okay, maybe we'll go 0.6%. What are the other ways that these advisor armies can compete with each other when it comes to their funds?
yeah, so it's funny you mentioned the ARK Invest point 0.8. That means you're paying attention. But one thing I would point out is like their initial filing, they had 95 bips. Then they had a filing that said it was going to go 70 bits or 0.7%, and now the most recent one says zero point 0.8, and they're the only ones disclosing their fees. Part of me wonders if like that's a little gamesmanship, like not showing their hand, like kind of messing with all the other issuers, because this is a lot of jockeying. Like you have some of you have the biggest asset managers in the world jockeying for position in the space, right? So everyone's going to try to do their own thing. How much of it is like, oh wow, this is going to cost more than we thought, this is going to cost less, and how much of it is we know what it's going to cost us to operate this thing, but we're just
Yeah.
going to keep messing with people. So one, I think I'm with you. I think the number one competing thing is going to be cost. Like how cheap is it going to get? Like if you're BlackRock and you're not, and you have somebody that's undercut you by half or some significant percentage, you're going to have a hard time competing, but that's not going to happen to BlackRock, right? Let's be very clear. The other thing is you have Grayscale coming into space that already has their $22 billion product. It would be one of the top 100 most traded ETFs, essentially just out of the 100. If it was an ETF right now and it trades OTC, it would be one of the largest ETFs immediately upon conversion. So that's going to be something that these guys are going to have to compete with. The other thing is some of that money in GBTC is undoubtedly going to flow out, right? Like, so a lot of people that
Yeah.
bought GBTC in these trusts, they were doing it to buy like based on the premium or discount. They're betting on that. They don't care about the underlying exposure. Additionally, ARK is a big investor in GBTC. They have a couple hundred million in there. So like they will undoubtedly, I can virtually guarantee it, they're going to sell out of GBTC at some point and buy their own product. So that's money that's going to come out of there and go to their own fund. And then ARK is like kind of like filling its own coffers and making it more competitive by doing that. There's going to be a lot of games and shit going on. There's going to be a lot of marketing. You're going to see, if you haven't seen it already, like I'm in the Newark airport, I've been in other airports around the country, and I've seen advertising for GBTC. They are not messing around. Van Eck has like put out all these commercials for Enter the Ether for their Ethereum futures ETF. It didn't really do well, but I wouldn't count them out. They've been here early. Bitwise is more known in the advisor community because they've been doing SMAs and stuff on this in crypto asset management for a long time. So they've been working with them. So everyone's going to try to use their own things, right? I think some people are going to find different ways to differentiate. I've talked about this on other podcasts. I also think initially this isn't going to happen, to be very clear, but like in a year or two down the line, you're probably going to have some issuers that are like, we're going to lend out the underlying Bitcoin. Your fee is going to be zero, and we're gonna like we'll give you a dividend and we'll take the fee out of like whatever we earn. And some people are like, you're gonna lend out my big, like that's gonna be insane to some people, and other people are gonna be like, your stuff's in cold storage, we're not touching it, it's completely invincible, all these other things. And more tradfi type people will be okay with the underlying lending, especially if like somebody like a BlackRock is operating it. They're not gonna be dealing with Three Arrows Capital as a counterparty. but but like, so there's going to be all these different, it's going to be fun to watch is really what it comes down to. But I don't think all 12 of these guys are going to be able to really do this. And then I didn't even mention like Invesco is partnered with Galaxy, which is a big player in the space. Fidelity has been a big player in the space. Valkyrie has been another crypto native people firm. So like there's all these different ways that I think people are going to try to play this. Um,
And
it'll be
imagine
fun. It'll be fun to watch.
imagine there, because it's not just the price of Bitcoin compounding, right? You got the fees that they're making also compounding with the price of Bitcoin. So every 4 years, you got 4x the budget to continue marketing your fund. It's going to be quite an interesting game. What do you think happens to the? I've got two last questions for you. What do you think happens to the 4 year cycles after the ETF? Because to me, the 4 year cycles make sense until you have a demand shock, which Bitcoin has never seen before, which would be the ETF. What do you think happens to these 4 year cycles? Does it
Yeah.
kind of
So the first thing I would say is like it's funny, like I'm in the TradFi circles and I'm trying to do the opposite of what I'm about to do is like I'm trying to talk to them like, no, this is actually a big deal. There'll be a lot of money coming in. But then I talk to you and people in the crypto space. I'm like, look, it's gonna take time for this type of the demand shock you think is gonna happen. Um, so I'll just temper that a little bit. But as far as the 4 year cycles go, I think part of it is also has to do with the fact of like how much the block subsidy is going down by, right? Like so early on it was meaningful, but we're now getting to a point where it's less and less like on a percentage basis that things are actually being impacted as like a total like impacting on the buying and selling of the underlying asset. I guess percentage basis is wrong because it's just being cut in half every time, but um, so I don't know. I've never been somebody who's like a 100% believe in the 4 year cycle, but like the data is hard to like
it's hard.
disagree with. It's like
It's
very
hard.
blatant, like this and this happens. Like it's, but like how much of it is like just because of like the nature of the people that were investing in that and the infrastructure around it was not as stable as it is now. So I mean I don't think the ETF necessarily will impact. I don't think that will be the main reason or the sole reason that if the 4-year cycle breaks, that it's because of the ETF. I mean, maybe it is, but like I said, no matter at the end of the day, whether you're buying it directly on an exchange or you're buying it via an ETF, at the end of the day, somebody has to be getting you that exposure to spot Bitcoin, right? So like that spot
Right.
Bitcoin exposure is in the ETF. So buying of the ETF is buying spot Bitcoin at the end of the day because somebody had to
Yeah.
sell it to you. So it's being stored there. So it's really like it's not necessarily to think about it as like it's this completely separate entity. Like it really is buying and selling at the end of the day. Whereas if you want to talk about
Yeah.
futures and rolling futures and the derivative aspect of that's a whole different conversation with leverage. But with these potential spot ETFs that we're talking about, it's you're just buying the underlying asset.
Yeah. All right. And my last question. I've been a big proponent of the ETF. I think it's going to do great. I think a lot of Bitcoin exchanges, the smaller ones, are going to get eaten up alive because same thing happened in the gold space. Um, what would you've got a 90% certainty this thing is happening by January 10th, right? So what are the if you had to list them out, what are the overwhelming benefits of a spot Bitcoin ETF to the
Oof.
Bitcoin market for institutional and retail investors?
All right. So there's a lot here. Um, First and foremost, like if you look at BITO, which is the Bitcoin Futures ETF, it's trailing year to date by 10%. Not great as a long-term hold. You look at its bid-ask spread, it's virtually zero. It trades penny wide, and there are no fees to trade it, which you cannot say about most of the areas where else you're trading exposure to Bitcoin, right? Spot Bitcoin ETF is going to do the same thing. It's going to make trading way more efficient for particularly for retail, possibly likely even for institutions in the market because that's just the way the ETF structure. It's what the ETF structure does, right? So it's going to make trading very very cheap. Exchanges better be thanking the gods basically that it's only Bitcoin because that's where they're making their money. They're making their money on those spreads and the commissions that they're charging, and those are going to be gone. So if you want Bitcoin exposure and you want to trade it, like there's going to be virtually no better way to do it than using these spot ETFs. And honestly, they're ready the BITO, the Bitcoin Futures ETF, is already better for trading exposure as far as I'm concerned than most every exchange out there. So that's the first thing. So if Coinbase only traded Bitcoin, I'd say this is a bad thing for them, even though they're the main custodian for like 80% of these filings. So that's one. Two is just convenience. Like, do not. Everyone always underestimates the convenience of
Yep.
clicking buy and being done with it, right? Like, if you
Yep.
want to get exposure to this, you had to create an account at Coinbase, Kraken, FTX, Binance, whatever, right? So, like, yes, it's easy for most people, but it's not that easy. And a lot of people are like, well, people should be storing the cold wallet. Like, I'm sorry, my mother and my father, if even if they're remotely interested in this, they're never going
Yep.
to do that. So these are the people that will benefit, and the other people are the advisors, right? Advisors right now, we know this from surveys. They have clients who have exposure to this in their own like Coinbase accounts or what have you, and the way an advisor makes its money is like, say you are worth $5 million and you give $4 million to the advisor to manage, and he charges a 1% fee per annum to manage that money, help it grow or keep it safe, what have you. Right now, a lot of that crypto asset exposure is outside of their umbrella. So what advisors will do when these ETFs come about is like put it under my umbrella. Yes, I'm going to charge a fee on it, but I'm going to manage it. I'm going to rebalance it. So I'm going to keep your portfolio at like 5% rather than let it go to 15 and then not do anything with it, and it drops to 5% on its own. Whereas I'll buy and make sure it keeps at 5% if it goes down, and I'll sell and take your profits when it goes up. So that's huge for advisors, right? Advisors, there's been products out there where they can tie in directly with some of these exchanges, these crypto exchanges, to get exposure if they really wanted to be at the forefront and getting exposure for the clients. But that's a lot of work to sign that up, right? Like, it's so much easier to be able to be like, here's all these infrastructure, these systems. If you look at an advisor like tech stack, they have like 50 different things that they deal with. They would much prefer just to be able to be like, click buy under the traditional financial rails and get their clients exposure if that's what they want to do, right? So that's the main thing it does. This is the most efficient way to put this product, this asset, on the traditional financial rails for the traditional financial ecosystem. So I think that's the number one thing that people like seem to think about. They're like, oh, this is the antithesis of Bitcoin, which I kind of get a little bit, but at the same time, this is going to draw people in. People are looking to add this to to their portfolios in big ways. And there's a few other tangential benefits, I think, but like for the most part, that's the main thing. So like if you have here in the States, like you have IRAs or tax deferred type accounts, and most of them are set up with like traditional brokerages like Fidelity or Schwab or what have you. It's not easy to, has never been easy to get Bitcoin exposure. Most people, that's one of the reasons why GBTC saw so much demand and why it was trading such a premium, because people wanted exposure in these tax deferred vehicles. Now, again, you can go to specialist providers and have a separate IRA set up that you can specifically use to invest in like alternative assets like this. That's a lot of work. Convenience actually matters. So this is going to be a way that people are going to use these things, in my view. And then obviously the institutional side of things. There's pensions, endowments, family offices, many other things that have like restrictions on what they cannot buy. They have to buy securities and bonds, and like this is what they're allowed to own. And this is basically going to securitize Bitcoin. An ETF is something that somebody who's only allowed to invest in securities will be allowed to invest in. So even if they wanted to, a lot of the documents, the founding documents of these types of institutional structures, they have not been able to get access to it. Now, I think some of the the herd is coming, the institutions are coming. I think a lot of that is overblown, personally, but like there's definitely people out there that are interested in the space and have not been able to get access, and this will give them an ability to get access.
Yeah. Wow. Well, James, listen, thank you so much for doing this. I know you're a busy guy, so I appreciate your time. And apologies, because I'm not a podcaster, so apologies if this wasn't as smooth as what you're used
Nah,
to.
this was great.
So,
Yeah.
so
Just having a conversation.
Yeah, remind people where they can find you on Twitter. You're one of my top 5 followers when it comes to Bitcoin, so I think everyone should follow you.
I really appreciate that. Thank you very much. Yeah. Again, it's just J and then Seyff, JSafe. And if you're a Bloomberg Terminal client, I don't know how many of your subscribers are. Most, like, we go into way more detail. There's some things we can't put everything out for free on Twitter, but we do a lot of teasing. We'll answer questions, and we put a lot out there for free for anyone who wants to understand what's going on. And the one thing I would say, you kept saying the 9%. It's funny now. We have when we said that, we got so much ridicule from a lot of people. Like, that's insane. That's never going to happen. And now all of a sudden everyone's jumping the bandwagon and arguing with us about like the specific date it's going to launch, and we're like, we went from like completely out of consensus with this call to all of a sudden now we're like in consensus, and we have all these banks joining us in our call. So that's been fun to watch. But that said, if these things are denied, I'm going to have to eat a lot of shit.
Well, let's see what happens. It's only a few days till January 10th. If I don't speak to you before then, Happy New Year, my friend. Merry Christmas and a Happy New Year.
Same to you. It was wonderful to meet you, I guess.
Thanks, buddy.
I'll be following along.
All right, so I hope you guys enjoyed that conversation with James. Please follow James. He's one of my top 5 Bitcoin-related follows on Twitter, and I highly recommend you follow him. Now, the most important thing that I want you to pay attention to what he said was that this is happening. This is not some wet dream of the finance world. This is moving forward. The conversations are in an advanced stage. Now, what that means for you is the urgency to get to 1 Bitcoin should be through the roof. And for most of you, it's not. You're still thinking about it. You're still thinking about it while the wolves are about to be unleashed on the market. Now, this is going to take a few years. It's going to take time because it's going to take time to compound. In the first year, they're going to put a little bit in. It's going to compound. They're going to put a little bit more in. It's going to compound, etc., etc. That's how this works. But that doesn't mean that you won't be priced out of getting to your 1 Bitcoin, because ultimately, there are still only 3 rules to Bitcoin. Step number 1, you buy Bitcoin. Step number 2, you shut the fuck up. And step number 3, you get fabulously wealthy.